We got consumer confidence data this morning, both present situation and expectations. That was better than forecast. And we also got a great reading from the Richmond Fed manufacturing data. Does this mean the Fed can breathe a sigh of relief after a run of weaker data?
Well, I think the Fed is first and foremost going to be focused on the recent slew of soft inflation data. Certainly any step in the right direction in terms of the consumer, it be that confidence or spending or manufacturing, is going to help support their argument. But really the juxta of their motivation comes from, again, that dual mandate of stable prices and full employment. So they're really looking for that inflation data to reverse course, which unfortunately it has not as of late.
Lindsey, I mean, as you say in your notes, you've got clear and ongoing signs of domestic disinflation in the US. So why is the Fed continuing to basically follow a consistently, to use your words as well, inaccurate and one-way biased forecast?
Well, it's difficult to say. At this point, the Fed is not entirely dismissing the recent soft inflation data, but they're saying that it's likely to be temporary. And instead, what they're focused on is their longer-term expectations for inflation, looking over the next 12 to 24 months. So the Fed is basing current monetary policy on the anticipation that prices will reverse course and continue to move towards that 2% target longer term. But in the near term, if we don't see that reversal, the Fed is left with a little bit of egg on their face as the latest policy adjustments don't seem to jive with the reality of the data. So they're walking a very fine line at this point.